Okay, let's get started. How's everybody doing? My name is John O'Donnell. Thank you all for coming today. My email address for any of you that would like to get in touch with me for any reason is John, John, at tradingacademy.com. A lot of people think I'm the founder of Online Trading Academy. I'm not. The company was founded back in July of '97 by A.L. Shahar, but I joined the team and became principal in the company in first quarter of '98. So this is our 15th year of operation, and I'm really proud of the team that we have built to, serve our clients and members literally all over the world. I'm also the co-host. My title at the company is Chief Knowledge Officer, which means I do a lot of economic research. And we're going to share some of that information with you today. I'm also the co-host with Merlin Rothfeld of our radio show. It's powertradingradio.com, and I would encourage you to visit it because there's over 500 hours of free content there, both in audio form and video form, with some very, very interesting guests that we have interviewed over the last 2 years. Sir Winston Churchill loved to speculate in stocks. I guess I should ask before we get started here, what city or country are all of you located in? So if you'd type into chat where you're located. Oops, we have no sound. That's interesting. Testing, 1, 2, 3. Do you have sound now? Okay. Mike says it's okay on his end, so maybe it must be your end, Vicki. Very good. Portugal, England. Where is everybody located? Type in what city you're located in, please. Lisbon, Portugal. Very good. South Africa. Gee whiz, we have the whole United Nations represented here today. Well, Winston Churchill's one of my heroes. He was quite a speculator in commodities and stocks, as a matter of fact, as was John Maynard Keynes back in those early days. But one of my favorite Churchill quotes is, he used to say, a pessimist sees the difficulty in every opportunity, and an opportunist sees the opportunity in every difficulty. Now, there's a lot of challenges going on in the world today, from the crazy sovereign debt crisis that we see going on in Western Europe, the very stressed economy in the United States that some people seem to call the cleanest shirt in a dirty laundry. Others like to call the American economy the prettiest girl in an ugly girl contest. And then let's not forget what's going on in Japan. Japan has been in recession, some would say depression, since 1989, as evidenced by their price on property and equities are in deep, deep discount from their peak now 22 years ago. But, regardless if you're bearish on the global economy or if you're bullish on the global economy, there's always opportunity if you're a trader. Now, before we get started today, we're going to talk a bit about the inflation-deflation debate. Some of you on this webinar are very bullish. Some of you are very bearish. But I want to do 2 surveys, and I'd like you to type in, if you're bullish on the global equity markets, type in that you're bullish. If you're bearish, type in that you're bearish. Then next to that, are you an inflationist or are you a deflationist? So I'd like to do a poll of our audience here before we get into this. I'll try to make it clear with the content I'm going to share with you, what our perspective is, but I need to know where you stand. And the more I know about you, the better we can shape this experience so we can both get something out of it. So type in, are you bullish on the equity market going forward? Or are you bearish? And if you're an inflationist or if you're a deflationist, just type in what camp you stand in. Now, everybody is entitled to a point of view and opinion. There's no wrong or right answer here because it is a debate. And the very nature of debate is that you will have a point-counterpoint. So I need you to type that in. Just let me know where you stand. Okay. Come on. Where are the rest of you standing? Well, I got that, but we have to sort through a direction in the global economy, at least from a macro perspective. All right. That's interesting. This individual is bullish on the equity market, I assume, but is a deflationist. And there's another one who's bearish, who's a deflationist. And then we got somebody here who is an inflationist, looking for a range-bound market, but looking for the market to decline from here. It's very interesting. But I don't have enough of you voting. Come on, more of you vote. I need to know where you stand. So let's get into this. Regardless of if you're a bull or a bear, or you're an inflationist or a deflationist on the monetary side of the equation, here's what we know about markets. And I'm going to show you, we're going to step back. Most of the people in this room are probably day traders or swing traders. I would assume most of you have most of your exposure in currencies. But we're going to look at the general economy, because the general economy of a particular country is by and large going to deliver the value of that currency and as it trades vis-a-vis the U.S. dollar. I think it's estimated that something like, of all the currency transactions done in the world on a daily basis, over 60 to 65% of them are contra to the U.S. dollar. So we're going to take a look at the U.S. dollar. We're going to take a look at the U.S. economy. That has a big impact. Now, a lot of you that are inflationists believe that we're going to have inflation because you see Western Europe, you see Japan, and you see America, central banks, monetizing trillions and trillions of dollars of fiat money, buying debt instruments because we've had a sovereign debt credit purge in Western Europe. Some of you are deflationists because you see the price of many goods and services, not all, declining in price. So one of the things we're going to need to do today is define the root cause of inflation and the root cause of deflation. And because you all have a point of view, and that's great, some of us have a way, and I'm going to say some things today you're probably not going to like, because I'm going to at least disagree with half my audience, and that's okay. That's what a debate is for. But at the end of the day, I used to teach debate, and one of the core principles of being a good debater and winning debates is listen intently to your opponent's arguments and attack them viciously. And so there's a lot of debate raging in the world today. And from a 30,000-foot perspective, I think you and I have to get this right. Whether we're a day trader or a swing trader, we need to do it within the context of the macro picture. And I'm going to show you some price charts today, especially on the price of equities, that show you that the markets have been very volatile as long as we've been keeping records. So the first thing I want to talk about is the root cause of inflation and the deflation profile. Now, at online trading, how many of you know a guy named Larry Kudlow, who is a prominent economist on CNBC? He also used to be a major economist for Bear Stearns, before they had some trouble. But Larry Kudlow has a favorite saying about the mother's milk of capitalism. And what Larry Kudlow likes to say is the mother's milk of capitalism, and I assume all of you are capitalists, or you wouldn't be here wanting to learn how to trade capital. He says the mother's milk of capitalism is is profit. What I like to say is the mother's milk of capitalism is the credit market. Now, this is a profile of the credit market in the United States, our total U.S. debt, both in the public and private sector, as a percent of GDP. So as our GDP would ebb and flow and grow and contract in multiple economic cycles since 1870, I'm plotting how much credit in the public and private sector did it take to create $1 worth of GDP? And as you can see, it's been as low as about 120% of GDP, which means it took $1.20 worth of debt to create $1 worth of GDP. And it's been as high as 370% of GDP. Now, this is the actual debt that's on the balance sheet of a private or public institution. It does not include the unfunded liabilities that are in the footnotes on the balance sheet. And there's a big difference between the two. Now, I want you to note something. What are the two components of every credit market, whether it's an automobile loan, a home mortgage, a corporate debenture, or even a sovereign debt instrument? What are the two components of every credit instrument? Type them in if you know the answer. The two components that I'm looking for are a willing lender and a willing borrower. Every credit instrument has somebody advancing the credit, and every credit instrument has somebody who's on the other side of that transaction that demands credit. So the borrower would be the demand for credit, and the lender would be the supplier of credit. Does that make sense? All right. Yes, at agreeable interest rate, with or without collateral, and for an agreeable term. Does that make sense? Now, from 1870 through 1920, note that debt as a percent of GDP averaged about 150% of GDP. But this led us to the credit binge of the 1920s, where debt as a percent of GDP on average doubled from about 150% of GDP to about 300% of GDP. This was an incredible growth period because you basically had too much money in credit chasing a relatively fixed amount of goods and services, and the symptom of that inflation process was a rising price for those goods and services. And ladies and gentlemen, that's what the definition of inflation is if you look it up in the dictionary. It's an increase in the volume of money and credit relative to available goods and services. Now, what happened in the 1930s? Well, the credit binge environment under Austrian business theory, which is different than Keynesian business theory, led to what I call a credit purge environment. Now, a credit purge environment means that somebody took away the credit punch bowl. And not only did the demand for credit disappear, but the supply of credit disappeared at an alarming rate. And look exactly what happened. Debt as a percent of GDP in the credit purge environment, which is symptomatic of the Great Depression, the worldwide Great Depression that it precipitated, was that debt as a percent of GDP goes from 300% of GDP all the way back to where it started at about 150% of GDP going into World War II. Now, why do we call this a credit purge environment? The reason we call it a credit purge environment is that these credit instruments are carried as an asset on the balance sheet of the lender, and they're carried as a liability on the balance sheet of the borrower. Does that make sense? So when somebody can't pay their mortgage, or a corporation gets in financial trouble and has to declare bankruptcy, and the federal judge converts creditor debt into equity, the credit is literally purged off the balance sheet of both the borrower and the lender, and capital is virtually destroyed. And that's why the cash that's left over in that system, in fact, has more buying power. And the symptom of this process of credit purge we call deflation. That is an environment where cash actually grows in buying power relative to goods and services. And we're seeing this play out today in the United States in the real estate market. We're seeing it in Western Europe, especially in Spain, Portugal, Italy, Ireland, Greece. Doesn't it take a lot less euros and dollars to buy a single-family home in America and in Western Europe today than it did, say, at the peak of the credit boom in 2006, 2007? Absolutely. But the rising price is only a symptom of the inflation process. A declining price is only a symptom of the deflation process. Now, John Maynard Keynes had a lot to say about this. Well, Monaco's different. Monaco's different because it's a very limited real estate market, and it's probably under very, very tight control. But in the end of the day, John Maynard Keynes had this to say about the process of inflation. And he said this in a book he wrote called The Consequences of Peace in 1919. He said, by a continuing process of inflation, government can confiscate, secretly and unobserved, an important part of the wealth of their citizens. And John Maynard Keynes, in fact, if you read him very carefully, was an advocate of inflation, was an advocate of the central banking process to dilute the currency supply. And ladies and gentlemen, it's no different than somebody sneaking into your home in the dead of night and stealing your assets. When you steal the purchasing power of the currency of a country or of a community of users, it's organized theft. There's no moral difference. Absolutely none. But let's go ahead and play this out. This is World War II, and let's look at what took place between 1950 and roughly 1980. That's about 30 years of time. And what took place was debt as a percent of GDP, and we had great growing economies in this period of time, as we did in the 1800s. The debt as a percent of GDP went back to about the 150, 160% of GDP level. And who was elected right here on about 1980? Ronald Reagan. And what did Ronald Reagan bring to the party that as the catalyst, the trigger, to create all of this massive growth of debt at an accelerated rate as a percent of GDP? What did he bring? What did Reagan bring to the party? Well, he brought a new punch bowl. We call it confidence. You see, there will not be an abundant demand for credit or an abundant availability of credit if there isn't confidence in the system. Confidence for what to happen? Confidence for a lender to lend and confidence for a borrower to borrow and consume. We need to have final demand for goods and services. Or, very predictably, we're not going to create any jobs. Now, let me ask you a simple, elegant question. If people have lost their confidence to borrow money against their home, we used to call that in America mortgage equity withdrawal, and use the proceeds of that loan to buy a new car or send a kid to college or finance in a luxurious vacation or maybe even start a business, and if lenders have changed their appetite to lend or dramatically changed the lending standards and look today at single-family homes as collateral value with not a lot of confidence versus where they were at mid-decade, you tell me what's going to happen to the velocity of money through our economy. Isn't it going to slow? And ladies and gentlemen, that's why the economies of the developed world, from Western Europe to America to Japan, and collectively those three economies make up 70% of global GDP. I want you to think about that for a moment. And that's the reason, ladies and gentlemen, we are not creating any jobs in the developed world today. But yet, the central banks of Europe, America, and Japan have thrown trillions upon trillions upon trillions of currency units at the problem, and they just can't jumpstart the economy. Why isn't it working? It's working. It's not working because the consumer has dramatically changed his appetite for risk to consume. Secondly, corporations, allegedly in America, American corporations have somewhere between 2.5 and $3 trillion of capital on their balance sheet. They're not buying their competitor. They're not expanding their widget factory. Their primary use of proceeds of most secondary stock issuances today is to pay down debt and de-lever the balance sheet. Now, the only entity that has not stopped levering has been the government entity. But the private sector is far larger than the government sector, especially in America. Let me give you an example of what I mean. In America today, we have about $2 trillion of cash outstanding, but we have $50 trillion of credit outstanding. Now, we only have a $14 trillion economy. So our credit today is about 350% of GDP. Take 15 trillion and divide it by 14 trillion. But we also have about $14 trillion of federal debt against our $50 trillion of total debt outstanding. So in the private sector, that is that sector not attached to a printing press in America today, we have about $36 trillion of debt. And it is that component of debt, that component that's not attached to a printing press in the private sector, in both the developed world, in Western Europe, America, and Japan, that is purging, that is deleveraging, and some of that's being done voluntary and some of it's being done involuntary. Now, ladies and gentlemen, let's take a look at where we are right here. What do we call this? If this is a trend of an accelerated growth of debt as a percent of GDP, roughly over doubling in a relatively short period of time, what do we call this bend in the road here? What do we call this? We call it a trend change. We call that a trend change. We call this, and ladies and gentlemen, what we are forecasting in Online Trading Academy is that we are in the early stages of a deleveraging credit purge cycle that at a minimum is going to take 10, potentially 15 years to cure itself. Because our economy, especially in the private sector, and at the city, county, and state level, and certainly the federal level, is just too much leverage that has accumulated over 4 decades. And now we're in the end game, and we've started the deleveraging process. Now, we can debate, and I believe it's going to be very deflationary. This is not an inflationary condition. Now, let me show you what this has done to valuations of the stock market. And we've had multiple. I've measured over 20 credit purge environments that our country's gone through since the 1870s. Now, of varying magnitudes, not all of them are equal. And some of them were before we had a central bank, and some of them corresponded after we had a central bank. Remember, the Great Depression of the 1930s happened after the establishment of the Federal Reserve System. Now, one of the macro views, this is kind of the 30,000-foot level of the valuation of the stock market. The stock market in my world is like reading the blood pressure of a patient who's having some chest pains. When the economy is growing and corporate balance sheets are in good shape and there's great in-unit demand and companies are running good profit margins and labor rates are stable and the availability of capital is abundant, you get growing economies. Now, let's take a look at valuation. First of all, I want to point out that the red line, and what we are measuring here, I guess I should talk about what we're measuring here because you probably haven't seen this chart. By the way, if you'll give me an email, I'll get you copies of these charts. My email address is simple. It's john@tradingacademy.com. But we're measuring the market value as a percent of nominal GDP. And then I'm going to show you a chart where we adjust the GDP and the valuation of the stock market for inflation. It has a totally different picture, by the way. But we'll go all the way back to 1924. Now, we're taking the total market cap of the New York Stock Exchange at $15 trillion, adding to it the total GDP measured at a little over 15 trillion nominal dollars. We're adding up the value of the New York Stock Exchange at 13 trillion, and we're adding to it the value of the NASDAQ at 4.5 trillion. And we're doing a little bit of math, dividing one into the other, and we're looking at the valuation of the stock market as a percent of GDP over time, both in bull markets and bear markets. And first of all, let's take a look at the extremes. Now, what do we know about extreme valuations of asset classes? We know from history of looking at tons of financial charts, as I've looked at, as I'm sure you have, is that extremes in price are never sustainable. My dad used to tell me the cure for a high price is a high price. And the cure for a low price, son, is a low price. Extremes in price are never sustainable. Now, the red line on valuation, and again, I'm measuring the financial health of our economy by using the stock market, the combined market cap of the stock market, publicly traded companies, as my benchmark, my barometer of economic health or economic decline. Look at the extremes here. The red line is at about 63%. In other words, from 1924 through 2012, and this goes into June of 2012, in taking out all the peaks and taking out all the valleys, the average or the mean valuation is about 63% of GDP, the red line. Does that make sense? Now, note the market in 1924 goes from roughly 28% of GDP right here to a peak of 88% of GDP. That was a huge move. And this was a period that we had looked at earlier of cheap liberal credit. So this was the bubble boom. The availability of cheap liberal credit, the appetite or demand for cheap liberal credit, financed the bubble boom. Bubble booms always lead to credit purge environments under Austrian business theory. And this was the credit purge environment of the 1930s that basically led the equity market to fall from 88% of GDP down to 26% of GDP, and 12,000 banks in America went out of business. Now, why did the 12,000 banks go out of business in America? Why did we purge all the weak banks out of the system? The simple answer is the credit instruments that they had issued to their customers became insolvent. The customers became insolvent, could not pay their debts. Therefore, the banks became insolvent, and they went out of business. It's that simple. So under our theory that credit is the mother's milk of capitalism, our position here is if you really want to understand what's going on in the equity market, you must keep your finger on the pulse of the global credit market, i.e. the supply and demand for credit. And it's constantly evolving, not only at the retail level, but even at the wholesale level, because there are certain industries or sectors that can readily raise credit. And then there are other sectors that are still credit impaired, like the real estate industry. The real estate industry across the developed world right now is terribly impaired. Now, it may not be that way in your neighborhood or your country, but your neighborhood and your country is not the whole world. Okay? So what drives this tremendous valuation extreme, which is what you and I trade, where markets go to valuation extremes of overbought that are unsustainable, then they collapse into valuation extremes that are oversold that are unsustainable. Your job and my job is to trade in this environment day to day or swing trade it in multiple asset classes but within the macro view of a pretty simple equation in our world, which is the global economy expanding? Is my local economy expanding? Or is the global economy contracting? Therefore, my local economy or the company I'm involved with contracts. It's pretty much that simple. Is the demand for goods and services rising? And if the demand for goods and services are rising at the retail level across the developed world, where is the retail consumer going to get the funding to buy the goods and services from the producers? It's really, in my world, that simple. So let's take a look at this. We see great bubble booms, and then we see bubbles burst. Then we see more bubble booms and bubbles burst. And let's take a look at this one between 1980. This is that great bubble boom. This is probably the greatest bubble in the history of the world. It's over a 1,400% move in the stock market, where we see the market go from, take a look at this, approximately 32% of GDP, 40% of GDP, take a look at this, all the way up to 180% of GDP. And on a relative basis, look how much more irrational, exuberant things were at an unsustainable valuation in fourth quarter of 2000 versus the previous bubble extreme that we witnessed in 1929 before the Great Depression. Now, ladies and gentlemen, this is measuring the Dow in first quarter of 2000, not only at 180% of GDP, but at 11,700 on the Dow. We subsequently have the collapse from 180% of GDP back down to 95% of GDP in 2002. We get the rally back into 07 at 144% of GDP. We get the tremendous sell-off back into March of 09, coming all the way back to 72% of GDP, almost touching the average or our mean red line, which is 63% of GDP. We get the rally out of March 9th, which is suckering a lot of people into the belief that we're in a new bull market, with the Dow today up around 13,000, the S&P today touching 1,400. The dollar starting to rally against the dollar index, starting to rally against a basket of peers. And of course, we've seen nothing, and here's where we are today. The market today is trading at about 118% of GDP. Now, let me ask you a question. If I were to connect these higher lows and these lower lows and create a channel here, what does it look like to you where we are headed? Where is this market headed? Because our position is, ladies and gentlemen, here at Online Trading Academy, is that we are in a secular bear market that started in March of 2000, and we are still in it. And this rally out of March of 2009 and all this pain that we have seen is the market continues to decline as a percent of GDP. Now, the GDP in America continues to grow, arguably somewhere between 1 and 1.75%, depending on who you talk to. Okay? Now, that's a very good point. Is this chart adjusted for the losing of buying power of the U.S. dollar from 1929? No, what we are doing in this particular chart, we'll take a look at that in a different picture in just a moment. We're looking at the nominal growth of GDP without adjustment for inflation, and we're looking at the nominal value of the stock market without adjusting for inflation. We're looking at a nominal measurement. Now, I'm going to show you a chart in a moment where we measure the Dow Jones Industrial Average in units of gold going back to 1980, where it looks remarkably different because we're using gold as our denominator. Because remember, from 1924 through 1971, the U.S. dollar was convertible into X units of gold. So we'll take a look at that in just a moment. So, ladies and gentlemen, here's where we are right now. We are going through a tremendous credit purge environment. Now, the average household in America has lost approximately 30% of their wealth. As a matter of fact, I think I have a slide on that. It's right here. The average American has lost about 30% of their wealth since 2007. And to put this in perspective for you in this credit purge environment, I'm showing you a chart here that takes our percentage job loss since World War II, starting in 1948. Each color on this particular chart, from 1948, 1953, 1957, etc., this is where we are today. You can see that what we are going through today, and what I call, if you take the average of the recovery of job loss in a recession, you can see that both the availability of credit and the demand for credit in these previous recessions, which creates a recovery in jobs, is nothing like what we are experiencing today. Now, if I were to go back to the 1930s, what we are experiencing today looks more like the pattern of the 1930s than any of these other recessionary recovery periods. So we are truly in something different this time. And what we are in different this time, and it is telling us that it's remarkably different this time. And remember, ladies and gentlemen, we have thrown trillions and trillions of dollars at this problem with massive deficit spending, trillion-dollar annual deficits, propping up the banks and zombie corporations, and massive bailouts for a select few, which I call crony capitalism. And with all of that, we can't get the economy to step forward and get any traction. Now, this is the data I wanted to show you. I got this from July 10th from USA newspaper. The data shows that the Great Recession that we were in has wiped out nearly 40% of the typical America's net worth. That's correct. The average American's net worth has declined almost 40%. The median net worth has plunged, this is the median, from $126,000 in 2007 to $77,000 today. And this is in lieu, and from 2007 on, of the trillions and trillions of dollars they've thrown at the problem. No wonder the consumer is not confident to borrow and spend. No wonder banks have changed their appetite and perception of real estate as good collateral value. No wonder. And of course, what we have seen, where was most of that wealth lost? Most of that wealth was lost in single-family homes. This has been the percentage decline, the ebb and flow of the value of single-family homes in America, because most of the net worth of the average American family was tied up in real estate. And their belief system got them in trouble, and you can see what's happened to the average American home across America. And we are still in the early stages of the credit purge for the single-family home. And the single-family home category is a heavily credit-intense industry, and it is at its peak probably in its ancillary industries, approximately 20% of GDP in the United States. Okay? Now, here's what we know during virtually all political cycles, all business cycles, and all innovation cycles in America. And America is still one of the leading, most innovative cultures in the world. And I'm so proud of our resilience, for us to hang in there and be resilient and get through this mess. And do not misinterpret me as a messenger. I believe we will get through it. I just believe we have some more pain to go through before we get to the final conclusion. Now, this is what we see happening between now and 2015, 2016 era. And it's a little cloudy on how long this is going to take, but I think the picture is pretty clear. This is measuring, and I get this data from the Federal Reserve System, and it's asking a very important question. How much debt does it take to create a dollar's worth of GDP? And how much of that debt is handled as a credit channel from banks? Because there are many other credit channels. Well, notice in the 50s and 60s and 70s, debt as a percent of GDP was between 36 and 45% of GDP. That's all. But remember, we had a very low-levered economy back in that era of time. We saw debt as a percent of GDP in the credit from 1980 through 2012 go up to 66% of GDP, up here on the hard right edge. And ladies and gentlemen, this is our forecast between now and 2015. We're going to come back to the red line. And what is the red line? It's the average. It's not the end of the world. It's not apocalyptic. It's the average. Okay, we've been there before. And what do we know about markets? We know that markets are mean reversion animals. That's what markets do. You know, they have wheat records. The price of wheat going all the way back to ancient Egypt. And when they reconstitute the prices, they mean revert. Mean revert is part of the human condition. That's why we trade, and that's why we use mean reversion as an important indicator. This is confirmation of how the Fed in America has blown up their balance sheet. This is blowing up the balance sheet, creating money out of thin air, trying to stimulate the system. And ladies and gentlemen, it really hasn't helped. You know, our economy is still growing 1 to 1.5% per annum. That's incredible anemic growth. The average economy grows at 3.5%. So we're way below trend, even after all this monetization of debt. Now, what does this do to the velocity of money? Velocity of money is a very important calculation. Velocity of money is that measurement of the money supply of once you turn your money over, you buy something in a marketplace from a vendor. How fast does the vendor turn your money over to his suppliers and employees, and how fast does the money circulate through the system? Well, take a look at this. You can see that the velocity of money has been shrinking since 1999. Yes, ladies and gentlemen, and that's why we're in a secular bear market since first quarter of 2000. No question about it. Now, we've had rallies. We've had some cyclical rallies within the long-term secular bear market, but we're basically still in a secular bear market, and I think it's going to run as a minimum until 2016. Now, we could debate that until the cows come home, but that's what it looks like from my perspective right now. Become a member of Online Trading Academy. It's free, by the way, to become a member of Online Trading Academy. Just go to tradingacademy.com website, and you'll see how to sign up and get a free membership. And we'll keep you updated on when the picture changes from our perspective through our newsletter and through our webinars that we host there as well. But ladies and gentlemen, here's another chart I get from to keep my finger on the pulse of demand for credit. I'm taking a look at both the voluntary and involuntary deleveraging of the American household. And remember who America is and why this is so important to all of you that live somewhere else in the world. America is only 5% of the world's population, a little over 300 million strong. But we Americans consume 24% of what the world produces. So when we consume, the world produces what we consume. So we're very important to the world. You've heard that same saying I've heard for years. When America sneezes, the rest of the world catches cold. Well, that's especially true because if we don't have an appetite to borrow and consume, you don't have a need to produce it. It's that simple. And we have too much capacity in the world to produce too many goods and services, and that's why you don't see a lot of pressure on prices. That's why you don't see pressure on wages either. And ladies and gentlemen, this is what's happening in the credit purge environment. Credit card debt is deleveraging. Automobile loans, deleveraging. Home equity revolving credit, deleveraging. Mortgage debt, deleveraging. And the blue lines may be the most important line of all. It's household debt as a percent of personal income, deleveraging. And ladies and gentlemen, we are in a deleveraging credit purge environment, and you need to adapt your trading plan accordingly. We're even seeing deflation in the CRB index as well. CRB index is the Commodity Research Bureau index. It's a basket of all the commodities. The energy sector, the ag sector, the base metal sector, the precious metal sector, and others. We are still it peaked in 2008, late 2007, and we are still in a deflationary environment. Now, we've seen these conditions before. This is the stock market of the United States in nominal terms again, and we all know that the U.S. dollar has lost over 93% of its purchasing power since 1913. So I'm measuring the stock market in a nominal currency from 1913 through 2009. I'll show you what 2012 looks like in a moment. And I have a surprise for everybody on this webinar. I have a surprise prediction to end our webinar today. Notice that we had a 500% move in the stock market right in here, where the consumer price index went up in this era 110%. Then we have the collapse into the 1930s. We have another 500% movement in the stock market here in an era and right after World War II, or through World War II, where the consumer price index went up about 74%. And then during the Vietnam era, following the Vietnam era, we had over a 1,400% rise in the stock market, and that was an environment where we had a consumer price index of about 200%. Now notice, this is World War I leading to this rise. This is World War II leading to this rise. This is the Vietnam War leading to this rise. How do you finance a war? How do governments finance war? They borrow money and deficit spend. They borrow money, they crank up the war machine and deficit spend. And sooner or later, the money trickles into the economy and you get the massive bull market move. Now let's take a look at this Vietnam period right here. This looks like a relatively flat period because of the gray box. But in fact, if I blow this period up, it really looks more like this. This is the period between 1965 and 1981, previous to the great bull market. These are humongous moves that we can trade. So even in these perceived flat periods of time, there are great volatile markets that we can trade. And that's why you need to learn to be a trader. Now, ladies and gentlemen, I'd like to end on this slide. I believe we're going to see a sideways to lower market through the 2016 era. Perhaps it'll splash over a little longer. But now I believe we're going to have another 500% move in the market. Between 2009 and 2025, this era right here, I believe we're setting ourselves up after we wash out all the bad credits, after we get rid of all the malinvestment that we've made as a culture in the developed world, and all the credit ultimately gets purged out of the system, I could see a big decline in the stock market from where we are today at 118% of GDP all the way back to the mean, which is about 63% of GDP, and somewhere in this period right in here, and this is what is recognized by all this sideways to down movement, and these are big price changes here, we could going to have, I believe, a high probability great rally coming out of the stock market. I'm not going to tell this to Bill Gross, okay? He'd get ready to retire anyway. I believe we're setting ourselves up in the 2016 era. We're going to have a lot of pain between now and 2016. We're going to have to deal with this. May well look like this between now and 2016 or worse. But ladies and gentlemen, I think we're setting ourselves up for another bull market. I've enjoyed being with you today. My name is John O'Donnell. I'd like to type my email address in here. It's john@tradingacademy.com. I have a whole series of webinars I have produced. If you'd like to have a copy of them, just send me an email and put in the subject line. Tell me a little bit about what you thought about this seminar today, and then tell me you want the slides. Send slides. Put in the subject line, and I'll send you a whole series of links that documents not only why I believe there's going to be a new bull market, but how to prosper in this environment between now and 2016. God bless you, good luck.